Wouldn't it be nice if you could see the shares you own all together in one place in full color to help manage your portfolio and make sure it's diversified? Luckily, there is. Hey guys, I'm Jasper, a financial market analyst working with Trading 212 to help improve your financial education. Please note that nothing in this video should be construed as financial advice. I'm sure you've probably heard Warren Buffett's first rule of successful investing: do not lose money.
The first rule in investment is don't lose. And the second rule in investment is don't forget the first rule.
It's obvious on an intuitive level that losing is bad. But just to really ram the point home, I'm going to make it obvious on a mathematical level too. Let's say you invested £100 into shares of McDonald's back in the year 2000. Then in 2004, the movie Super Size Me gets released. In case you haven't seen it, it's a pretty ingenious documentary about what happens to you when you only eat McDonald's for 30 days. Suffice to say, nothing good, and it wasn't too good for the share price either. Investments in McDonald's had a big smack. Anyway, the outcome of these negative developments was that your hypothetical shares of McDonald's purchased for £100 are now worth £50. You just invested in one of the most famous brands and successful companies to ever have existed, but somehow have suffered a 50% drop in the value of your invested capital. Pretty bad. And even worse than this is the fact that to climb out of this big loss, you will need a really big win. So your stock is down £50. It just needs to make back £50 for you to break even, right? But that is sort of an optical illusion. What you need to think about is percentages. A fall from 100 to 50 is 50%, but a move from 50 to 100 is 100%. To get back from £50 to the £100 you started with, you actually need a 100% return on the share price, which is quite a tall order. This is why veteran investors evaluate every investment decision firstly through the lens of possible losses. Now that we appreciate the seriousness of seeing a substantial decline in the value of our investments, we can move on to answer the question of how best to avoid losing money in the first place. The good news is that there is a comparably simple idea that allows investors to minimize but never totally eliminate the risk of losing money. The even better news is that this idea is hardwired into the Trading 212 Pies feature. Trading 212 has designed the Pies feature to help everyone build and manage their portfolio in line with the only concept that allows you to minimize the risk of losing money whilst giving you the best possible chance of making money: diversification. Diversification is without doubt the single most talked about topic in investing, and for good reason, because it is the best way to ensure your portfolio stands a fighting chance of rising over time. Diversification means making sure that your portfolio contains a variety of investments, rather than concentrating too many of your limited resources on one investment. This is because no matter how great an individual company, fund, bond, commodity, or investment trust might be, it's not guaranteed nor even likely to rise steadily and predictably over every time frame you might consider. By spreading your risk across a good selection of solid investments, the hope is that even if one or two of these investments are struggling, others will be doing well. The net effect of this should be to smooth out the inevitable ups and downs of share prices and leave you with a basket of assets that can produce good and more stable returns over time. Now, before I talk about diversification with Trading 212's Pies, I want to talk about McDonald's again. Maybe I'm hungry. I know a few of you will be thinking, well, who needs diversification? You just need to not pick the stocks that will go down 50%. First point, get over yourself. The best investors in the world make mistakes or just get unlucky with the shares they own. You will always have some losing investments. The goal is to win more than you lose. Second point, let's quickly talk about what has happened to McDonald's shares since 2004. In fact, instead of talking about it, let's see it. The shares boomed 1,400%. With the benefit of hindsight, we can see that McDonald's was still a fantastic investment, but a diversified portfolio would have helped you weather that 50% drawdown and probably stop you from selling out at just the wrong time. How do pies help you to diversify? As mentioned in my last video, What Are Trading 212 Pies? A pie is a collection of individual securities that when put together can be tracked and invested in as a group. A group of securities instead of just one. What does that remind you of? Ah yes, exactly what we just spoke about, diversification. Pies encourage you to think in terms of a diversified group of investments that work together rather than each individual investment by itself. What's important is that the pie is performing well, not what the different slices within the pie are doing. Because remember, when we have a diversified portfolio, the investments are different, and if you've done it correctly, the stocks should be performing differently at different times. Thinking about the pie as a whole helps you not get too happy about when you're winning stocks, nor too upset over your losers, because probably in a few months, they'll all change roles again anyway, where the winners become temporary losers and the losers switch to winners.
I'll always be a winner.
Can you achieve diversification without pies? Of course, but why would you want to? The visual nature of pies, where each stock is a slice inside a big pie chart, in my humble opinion, makes it just that much easier to see how much you have invested into each stock relative to others, i.e. how diversified your stocks are. By the way, you can include any security traded on Trading 212's platform in your pie, and you are free to set up any combination which you think suits your preferences best. For example, if you believe that technology stocks are set to outperform the wider market, if you think European banks are undervalued, or if you believe the price of gold is going to the moon, you can skew your pie to include assets reflecting this view. How do pies help you manage your portfolio? Now, what I've talked about so far is in essence stock selection. Choosing the stocks you want to invest in and using pies to make sure you have a diversified list. Once you have built your pie containing all the securities you want to have exposure to, and you are satisfied that the overall basket is suitably diverse, you are now ready to take advantage of automated investing. A pie allows you to make a single cash investment into your account, and then Trading 212 technology splits that cash sum up and allocates it to different securities in the exact ratio specified in your personal pie. This is much quicker and less time intensive than the old approach, whereby you'd have to first put your cash into your account, then go through the painstaking process of buying each individual security one at a time. Furthermore, to maintain your list of stocks in the ratios you originally set out, you normally also have to make a series of calculations to work out exactly how much of your cash lump sum you put into your account should go into each of the chosen securities. Lastly, depending on the shares you wanted to purchase, it may or may not have been possible to do this manually in your specific amounts you wanted. For example, if you had £100 to invest in, which you wanted to split between 3 shares, but one of the shares was worth over £100, this obviously would not have even been viable. Because Trading 212 offers fractional share ownership, regardless of the amount of money you have to invest regularly, you can still put it towards the group of securities you want. Let the pie's algorithm take care of the calculations for you and allocate your cash to your investments exactly in the proportion that you want to. Let's review the main ideas I've tried to put across in this video. Firstly, losing money sucks. And not just the losing bit, but the example of McDonald's shares shows what sucks even more is the size of the winners needed to make up for the losers. The conclusion, therefore, is to do everything you can to stop those big losses from ever happening. Others may reach different conclusions, but I'm yet to be convinced that there is anything else other than diversification that can reduce the chances of these big losses happening. By the way, I'll give a more detailed example of how to build a properly diversified portfolio using pies in an upcoming video, so look out for that one. So we want to avoid big losses, and we think diversification can help us do this. So lastly, we want to make diversification as simple to do as possible. You still need to put serious thought into it and take responsibility for your own investments, but the visual properties of pies, along with the ease of maintaining them with Auto Invest, can make the process of building and maintaining a diversified portfolio a whole lot simpler. All right, I'm calling it a day, so over to you out there. Please share the thoughts you have on using pies and diversifying your portfolio. And if you like this video, please make sure to smash the like button, subscribe, and hit the bell icon so that you see more videos like these as soon as they're released. Thank you very much for watching, and happy investing.